Hello, Warriors. King Dollar is abdicating the throne. So I believe President Trump's probably happy about these two candles here. What do you think? And we're on the verge. This was a 200 it held. Really interesting. And it's not, looking backwards. 97.80 was really important. And that's exactly where the failing rally went to. So here we are, on the precipice of a breakdown. It's also bullish because Euro has taken over the leadership. And I believe it was down in here that Blake had a wedge that we came out of. I think it was over 12.15. He was going with it. He talked about it pre-Fed yesterday during FACE. I tip my hat to you, Blake Morrow. Great call. Was looking for a weaker dollar, and we got it. In fact, the blog that we put out gave you a chance on that failing rally to position yourself for this. Some pretty talented guys here. So, good morning. Anyway, so here we go on what's going on here. I'm always distracted by this. So let me just handle something here. Turn this off. Also want to welcome our viewers to investing.com. I have a great interview today. It's going to be Mark Yusko. So Mark is well known in the crypto world, and before crypto even existed, did quite well in all the financial markets. He's a CNBC contributor, so I recommend you stick around for Mark. They're always very lively conversations, and Mr. Yusko does not hedge opinions, okay? So he's going to tell you what he thinks, and it's not going to be if this, then that type of hedging opinions and market views. So looking forward to talking to Mark. Right here in the end, we finally got to, or almost got to, this red line that I had for a while. So I'm long, probably early, have some in at 59, have some at 82. We could get another flush here. And yesterday I talked about yields, and we needed 209 for a weekly reversal, and that's not happening. But look at where it went to. Those off numbers are pretty good. Went right to 209.90 before the sell-off. So as you can see, we are beginning to diverge here. And if you look at the 30-year, it's not as weak as a 10-year, okay? Almost looking to leave a little island here, we'll see, but diverging. So I know it's a ice crack type of trade to bottom and top pick, especially a prolific bull market like the bonds, but I'm giving it a shot today in TLT. The way I look at TLT is we're going to be at new highs, and we're not going to be confirming. So I'm looking at a Friday, Monday, Tuesday sequence for a high in the bonds, and hopefully, well, not hopefully, if I'm wrong, I'm wrong, some type of low in the yen. So in the face of a weak dollar, we'll see what happens here in US dollar yen, especially since the dollar looks like it's going to continue. And all week, Blake's been talking about it. Steve's been talking about it. Gregor earlier on showed a move over 400 in gold. The silver, I don't think anyone should be surprised because talked about this falling wedge. That breakout happened quite some time ago. Then we had another breakout of, I don't know if you could call this a cup and handle, and this being the handle, but we broke out at 1505. Gold's actually outperforming silver today. but this move measures, if you just take it from here up towards the wedge line. So we'll see. Sharply higher metals portend a lower yen. So that's the one thing that bothers me, because I can't short this stuff when it's has momentum like this. See the silver momentum? You might get a pullback, and the gold momentum. This is 1 hour time frame. These readings are powerful, 85. So you might get a top, but it won't be the top. And now you have everyone in gold, the whole world. I think it went to the weekly breakout on there, maybe even gotten above it. Let's see. Yeah, here's a green line. So we're actually trading above it. So I don't think there's anyone short gold anymore. I think a lot of the bears had to capitulate with stops over this high, stops over this high, and now you're going to start hearing calls for 15, 1600, and I'm going to go with Grega that I think he said 1420-ish, and I think that within a few weeks this may end up being a false breakdown, but that's just purely conjecture. But when I hear it from guys like Grega and some other people I respect, that we will get the breakout. We should have follow through. We could have another $40 in it from where it's trading right now. So, you don't want to step in front of this kind of momentum. That's the bottom line. Okay. You don't short markets that are confirming price highs. Everyone with me? That's one of the major things I teach is when markets confirm in both price and momentum, they rarely turn except for, little minor corrections, and confirmed highs and lows tell you as a trader, you get a confirmed high, you should not be looking to short it. You should be looking to buy a pullback and see if the next high confirms or doesn't. Markets rarely peak when they're confirming the price with different momentum indicators. I just happen to use a real simple implicator, RSI. Okay, so Blake, great call. I think you probably had a good week yesterday.
Yeah,
That's
it was
my guess.
Yeah. Good morning. It was
Hey, buddy.
It was good. Yes, it was good.
All right. Well, and you know why it was good? Besides that, you're a decent trader. You prepped for it. You prepped for it. Okay. You knew what you were looking for before the Fed. You got what you were looking for during the Fed, and you planned it out. So aren't your best trades the ones that you imagine before they manifest, so that you're not analyzing, you're executing? You were ready to execute during face yesterday.
Well, yeah,
hours before the Fed.
That's what gives you the confidence. Usually when you have a plan that you plan, it's something that you plan out and then it works out the way you planned, and which isn't always the case. But when it does happen the way that you imagine it's going to happen, that gives you the confidence to be a little bit more aggressive and hopefully let it play out. The problem was, and let me explain to you what the big issue was for me, and why I didn't make as much money as I should have or could have, is because the move didn't happen until Asia.
Yeah, right.
And that's I made some money yesterday, but I made a majority of it right after the New York close, and gold started to break out and it started to drag all my dollar shorts up with it. And which is fine, but the problem is that in Asian trade, what I did is I took my profits and because the last thing I wanted to do is go out in Asian trade at one level and then wake up the next morning, and Europe a lot of times will reverse whatever happened in Asia. So I didn't want to put myself at risk of that happening. So I took some profits, and then I woke up this morning and said, "Oh, damn, I should have completely hung on." But that's, I'm not going to beat myself up.
You never go broke taking profits.
No, I just should have made a lot more than I did, but I still made great money, so I'm not going to discount that.
What do you think that all the movement in Asia was based on BOJ, Blake?
No. It was just going into the pit close, and Gold just started squeezing.
Yeah,
Like,
okay.
you had people that were short. They're like, hell, I don't want to be short anymore. And, they just got the crap squeezed out of them. Uh, and that just ended up dragging the
We
dollar.
talked about that too. The whole scenario that you painted yesterday ended up coming out on the canvas. Very nice work, Blake.
Thank you. So let me talk a little bit about where we're at and what to do here, because I was talking to Jack, I've mentioned he's a young student who's sitting next to me. Not a he's not a I don't want to say he's a student, because he's not originally from the Forex Analytics community. He's just, he's a son of a friend of mine, and our kids, or well, my kid and my friend, that our sons play baseball together. It's my son's baseball coach, his oldest son, who's sitting next to me. He's just very interested in currency trading. So he spent a week with me a few weeks ago, went on a couple of breaks, and then he came back, and he's spending this week with me a couple hours in the morning, every morning, early morning. He's a young guy who's getting here at like 4 o'clock in the morning, which is pretty impressive. But anyway, I was talking to Jack this morning about what the natural inclination of a trader is. The natural inclination right now is for, let me just map it out for you. So you went to bed last night, or you turned everything off. The euro was trading at 112.40.
Mhm.
And you're like, oh, I should be buying the euro here. Gold's breaking out, but you didn't, because you're like, oh, I'm going to enjoy my night. I'm going to spend time with the kids, and the family, or, with my girlfriend or boyfriend, whatever. And then you get up this morning and the euro's trading, at 113.10. And you go, well, I should have been buying it at 112.40. And here we are, 60 pips higher. I definitely don't want to be buying here. So I'm going to start shorting it because it's way overbought. Look at these RSIs. The RSI is way overbought. No way it's going higher than this. I'm going to start shorting. That's the natural inclination of most people. I'm going to argue don't. I saw people coming in. The dollar Canadian is trading at 131.80. I'm going to start buying it. Here it is at 131.60. Well, if you liked it at 131.80, it's at 131.60. You've really got to start liking it now, right? I mean, let's not discount the fact that gold has been in how many year, Steve can tell me, how many year consolidation have we been in gold? Well, Stelios would be the person. He's not here right now, but how many years have we been consolidating?
I am here.
He's here.
Oh, you're here, Stelios. How many years have you been waiting for gold to go
He
up?
just came out of the water.
Let me just ask you that.
He just came out.
Yeah, it's been a while.
He had hair when actually went into consolidation.
Oh, he had hair. That must have been at least 15 years ago. No, just kidding. But he's really, he's correctly been, expecting gold to break to the upside, which, there's been a lot of people that have thought gold's going to trade below 1,000. So, great call. But it's been, let's not ignore the fact that gold's been really in a consolidation for the last 5-6 years, and we're finally starting to break out. So given the fact that we're starting to break out of a 6-year consolidation, and today may be day one, not yesterday, not last week, not 4 weeks ago, today, day one of a potential breakout of 6 years of consolidation. The last thing you want to be doing, in my opinion, is trying to buy the dollar when gold is breaking out like this. And look, I'll be real confident about gold on a move above 1400, especially if we get a nice consolidation above there. You guys can, and even if you go, well, it's Blake, look, we're not even at the levels that we've seen since 2014. By the way, the spike overnight was at 94. This high here was at, I don't know what it was. I have to go, what is it? 1370 something. 1391. So, I mean, we were trading at levels we haven't seen since 2013. But even if you want to just argue with me and say, well, we're at levels we haven't really been at in the last 3 years. We're breaking out of a 3-year consolidation. This is a big move. And you notice gold's not pulling back. Do you notice gold's just consolidating? The longer we consolidate after a move like this, the stronger the likelihood of a break higher is. So why am I pointing that out? Well, I mean, if gold, let's just say for argument's sake, let's say I'm right. Gold's just consolidating, and here in the next 2 hours, gold starts to make another move towards these highs. What do you think is going to happen with the dollar? My 2 cents is the dollar may be in this little, recovery right now, but we're going to just do this again. We're going to go, right back down into new trend lows. So what I'm doing, all I'm trying to do right now is I want to buy the euro on a pullback, buy the Aussie on a pullback, short the dollar Canadian on a rally. Can you make money going counter trend? Is it possible? Hell yeah, it's possible. Of course it's possible. If you shorted the euro 113.10 this morning or 113.15, you're probably saying, hey, Blake, go shove it. Look, I'm up 15, 20 pips. What are you talking about? This is the top. I'm in. I already shorted it. Look, you can do whatever you want, but you are fighting probably a pretty strong trend. So, can you make a few pips going the other direction? Yeah, you can, but you're really putting yourself in a very precarious situation by doing so. All right. I was just thinking, the first thing I got up and I jumped in my chat room and I saw people buying the dollar Canadian at 131.80, and I'm like 85. And I'm like, why? First question came to mind, why? These commodity currencies are getting, they're just rallying right now because crude's bouncing off the lows. Gold's breaking out, silver's breaking out. Why would you be, shorting some commodity currencies right now when you got every commodity ripping, in anticipation of higher, inflation down the road? It's with all this more stimulus coming globally. It just doesn't make any sense. But anyway, but what I'm trying to say is you can make money going counter trend. Good luck. The safer way to trade, if you want to say that, is just going with the trend. Find some dips to buy. Like I said, if this is day number 1 of a massive consolidation breakout in gold, and let's say gold closes above 1370, which is all I really care about today. All I care about today is, hey, if gold closes above 1370 or 1375 is really, on spot price right here, that's it. You just got, I might have to just chase gold at this point. I'm really, I've already, I'm long some, so I'm going to have to be long more, because if it doesn't break down, then there's only, so I would say if it's, not going down, there's probably only one other direction for it to go. And this is a big move, and we're going into the end of the week, and we close the end of the week closer to 1400 in gold. You're going to have everybody and their mother's brother's uncle looking at gold going, holy crap, I need to get on the train or just stand aside. And that's when these big moves start to develop. That's my take, is you either get on board or get out of the way. That's it. You get on the train or just get out of the way, because it'll just mow you right over. So look, hopefully the comments I'm giving you, and I'm not, trying to bash anybody, what I'm trying to do is, keep you safe in a situation where things can get kind of gnarly. And things can get kind of aggressive going the other direction. So anyway, I'm looking to buy Euro dips. I'm looking to buy Aussie dips, and I'm just hoping they can dip. That's my only hope. But now I have to trade. I'm gonna have to trade some currencies in Hopeville, which I hate doing, because I don't like to chase, and I feel like chasing them at this point is what it would be doing. But at the same time, I don't want to fade them. Sometimes you'll hear me say they're too strong to be faded, or too strong to be faded, but too overbought to be bought. And that's kind of where I'm at with the currency market. But you look at gold rips to a new high, which we're almost at new highs of the day, or we're trying to break out of this triangle. We're almost new highs of the European session. We start breaking into new highs. The only choice for the dollar is going to be is probably going back down. We'll have the euro trading at 113.20 and the Aussie trading at 69.50. That's the fact. Steve, what do you make of this big move in gold and silver?
I think it makes sense. We got confirmation yesterday of what is the beginning of a new reckless move in monetary policy, which is bound to create at some point inflation. And I think it's going to come at some point with a vengeance. And the market is starting to price in that. That's why Dale very correctly mentioned at the beginning, he had a look at the bonds and he said, yields, are at the lows, but from what I saw, the 30-year yield didn't actually move that much. And, we had the curve steepening, and that is exactly what I expected to happen, because I think that the markets are going to start expecting that no matter what happens in the short term, which is, controlled almost exclusively by what the central banks are doing, there are going to be medium to long-term repercussions. And that's going to be moving the market, dollar, metals, everything.
Yeah, I mean, I think this move in golds is a pretty massive move, Steve. I mean,
it's a huge technical event.
It is, and I hate being on the same side as Peter Schiff, for crying out loud, but I know Stelios is your idol.
Yeah. Well, you know what, my 2 cents, just like Steve said very correctly, we have pretty much all major central banks going for more accommodation now. So I have this feeling where it's kind of like a deja vu from 2008. And I look at the Fed, and I remember back then I was aggressively lent in rates. So basically I wanted rates to go fast lower, and they did, and people were saying, but the curve is pricing 3 cuts already. What do you think is going to happen? And I was saying, I think they're going to be cutting 50 basis points at a time. And we know what the Fed is like. When things start moving and they think they need to do something, they're going to go fast. So yeah. I'm having this deja vu with that, and that's why I think metals are going to fly. And we have ECBs doing the same thing. Actually, the only central bank dissenting is Norges Bank.
Norges Bank.
Yeah. They hiked, and they indicated another one coming this year. Will they deliver that one? I don't know. But
actually, it's one of the reasons yesterday I used the knock in the chat room after the Fed event. I wanted to choose something to be short dollars against, and I chose actually the knock. So today's Norges Bank.
And it looks like you chose correctly, Steve.
Yeah, as it seems.
Yeah, we broke, and it was a great call by Amazing. You, by the way. So hopefully, I just want to say I hope everybody understands what I was saying regarding the dollar and gold and what's happening in the market. I hope that it's all making sense to everybody out there.
And Steve made that call. Where were you when you made that call?
Steve, when Steve made the call on the US dollar Norwegian krone, I think he was, if I'm not mistaken, it was probably trading like right around 8.
No, 6, I mean, where
you mean, where was the pair at 8.70?
No, where were you? Where were you sharing that?
In the chat room, as I said.
Oh, okay, in the chat room. So how do people get into the chat room that are watching us?
You know how to make a sales pitch.
Who sells you better, buddy? So anyway, that's
His wife.
yeah, she's pimping them out. Listen, you Face is an hour of us sharing our stuff, but like yesterday in the Fed, if you know, think about what you would have paid for a subscription and just that one idea yesterday from Steve. And I'm sure ideas were flying in there yesterday, Blake, weren't they? Did the
There
room
were, I
catch
think,
weak dollar and stuff like that? A lot of guys in the chat room.
yeah, I think for the most part, people did really well yesterday. So, so anyway, well, guys, I'm going to pass it over to you. Good luck today, and I hope my words don't fall on deaf ears. I hope it makes sense to you. You look, gold looks very bullish, and you have to just respect the fact that gold and the dollar have probably one of the best correlated relationships in the market, which means, you know, if gold's going up, silver's probably going, or if gold's going up, dollar's probably going down, you know. And so just be careful if you're trying to fade that dollar move. I'm looking to buy euro, buy Aussie on dips if I can get it.
Goldfinger is the one with the Midas touch.
My God.
Ancient Greeks, Blake, used to say that smart people learn from other people's experience. Stupid people learn by repeating their mistakes over and over again.
Yeah, that's true.
Stop calling me names, man.
All right, guys. Hey, I'm gonna let you go. I've really got to get back into the markets.
Thanks,
All right, see you, Goldfinger.
Bottom line, people are lucky enough to have people like Blake here.
He loves only gold.
Yeah, that has enough experience for 10 lifetimes. Yeah.
He's been to a few rodeos, that guy.
A few more than a few. Eh?
You know, I used to go and watch the gladiators in the Coliseum. That's how long I've been around. Anyway, okay,
Nice.
go ahead.
Actually, have you been to the Colosseum?
No, you know, I've never been to Europe, and my first stop in Europe is going to be
Greece.
To see you guys. Yeah,
absolutely. But the Colosseum is nice, and Rome is a very beautiful city. I definitely suggest it to anybody.
Yeah, ground zero for the Euro crisis. All right.
All right.
Okay, so we have a lot to talk about, but let's have a look at. We have data.
2 minutes.
In 2 minutes, I'm going to put this up. Stelio, it's your turn, and I'm going to just interrupt you for data, and then we're going to go over everything.
Sure thing. So let's finish off with Norges Bank first. You know, they did hike, and they're signaling one more hike in 2019. The thing to remember is that the currency is still relatively cheap historically.
That is very true.
And if you look at their exports, exports to the US is about 5%. Eurozone is the biggest trading partner. So if you look at Euro Norway, it's still quite high compared to the range. It's still at 9.
Keep a close eye to this trend line in the Euro NOK, by the way.
Yes, that's the one I'm short a lot of.
It dates back to 2012. If we break below it, if you want to be a little bit more safe, you can also target the previous low here at 955. I think this thing is going to collapse.
And it's got positive carry, good positive carry. So it's a no-brainer for me at least. Okay, so we also had the Bank of England today. They kept rates unchanged as expected, but they were also a little bit dovish. They talked about downside risk increasing due to global momentum slowing. That makes sense. They talked about the Brexit risks being slightly elevated, and they downgraded the growth forecast and the inflation forecast lower. So they are singing in the same tune as most of the other central banks, and it kind of makes sense until Brexit is we get some closure on Brexit. Boris Johnson has won another round of votes, and with over half the votes of the MPs, he is the favorite. But as Amanda correctly said,
let's pause for a second.
Yes.
Now.
Yes.
So let's see.
Philly Fed, really, that's the one. What is it?
Okay, initial jobless claims as expected.
Yeah, that's not the important number anyway.
I know. We still don't have the Philly Fed number. Let's see.
Oh, that's not good.
God.
Yeah, this is not good. So,
whoa,
you know,
this is amazing. I mean, from 16.6, we were expecting 11, and we're at 0.
yeah.
Basically.
You know, leading indicators are collapsing in the US, so this is really not good.
Yeah.
Wow.
Yeah, wow, indeed.
Well, it's so bearish. This should take the S&Ps to over 3,000.
Oh, absolutely.
Things are so bad that we're having parabolic
bad enough.
stock
Yeah,
market.
it's bad enough for the S&P to go vertical.
Huh?
Yeah.
It's unbelievable,
Bad enough,
isn't it?
Yeah.
Good thing that we're not fundamentalists.
Yeah.
I personally think the drop in equities will come, but it will not be anywhere near as severe as it was in 2008. But I think, I think 25-30% it can come. But look, all this accommodation and creation of money and credit, what is it going to do to indices? It has to take them higher eventually.
So maybe like back to 2000 in the S&Ps, and then we rip to 4.
2200, I think, is a good
target.
I think we should honestly, because I know that not everybody is interested in that. For a discussion on fundamentals and monetary and fiscal policy, etc. Yeah, I think we should have a special webinar for that. But bottom line, in just 10 sentences, the monetary policy experiment has failed. End of story. How do we know that it has failed? I remind you, 10 years ago, Bernanke was actually swearing in Congress that what the Fed was doing was monetary policy special tailored for special needs, for emergencies.
Right.
And he was promising that, don't worry, we're going to do that for a short period of time until things settle down to normal.
Well, and didn't he also say, Steve, that he was doing that for a short period of time? What he was worried about was political will, which meant the handover to fiscal stimulus.
Yeah, exactly. But now we know that this experiment has failed. How do we know that? Because before we even get off the next recession, we never managed to unwind the balance sheet. The balance sheet went from like 4.5 trillion to 3.8, 3.9, whatever it is, doesn't really matter. So a minimum unwinding of the balance sheet. And even to accomplish that and take rates back to 0, and now I'm talking about real rates, because we have an inflation rate that is roughly 2%, if we even consider the methods that are measuring inflation. But let's take that, as the real one, and and monetary policy rates at 2.5. So we in essence, we have real rates just above 0, and now they want to take them to negative once again. And obviously, as you understand, I've said it since last year, what is next to follow is more quantitative easing. So they're going to have managed to shrink down, only temporarily and at a very small extent, the balance sheet before they inflate it again. Who knows for how much it's going to go to 10 trillion? Who knows? The US, and it's not an exception, of course, but we're talking now about the US because we had the Fed yesterday, is running record deficits, theoretically speaking, during a period of expansion, right? And in what Trump claims to be the best economy the US ever had. So who knows what the deficit is going to be once we're officially in a recession, and once we officially start seeing the results of inflation, which is going to be big jump in unemployment, of course, big issues with corporate debt, which is a problem. 40% of Americans, which is one of the richest nations, doesn't even have $400 aside in case of an emergency. Imagine what's going to happen during a recession, right? So, the other pillar of any expansion that we've been seeing during the past decades in developed countries, which is consumption, is also going to suffer magnificently. And the only thing they have in hand to do it is monetary policy. That's why now the MMTs has become so popular, because at some point they're going to have to do that as well. and they're just hoping that there is not going to be any blowback because of that. But of course there is, and we know what it is by looking back in the past. I mean, the 1970s are not that back, and I'm not going to even mention recent examples for other countries. I'm just going to mention the US. The 1970s are not that back. Okay, yesterday there was a reporter asking Powell if they will change their inflation target to 4%. Where do you think this question came from? I mean, do you think that this guy was mad? He woke up one morning and said, obviously he knows something, and that's what they're going to do next, simply because when inflation comes, they won't be able to fight inflation, so they're going to just ignore it or claim that don't worry, it's normal, symmetrical. Now we have
or change the way they calculate it.
Yeah, again and again and again and again. But I tell you, I think that no matter how much they change the way they calculate, at some point it's going to be measurable.
Yeah.
You know what I mean? That it's.
Yeah. And we all know what real inflation is. It's nowhere near where they're saying.
Oh yeah, absolutely. And then we're going to have huge social unrest, and that goes to the rest of the developed countries as well. Because what happens, inflation erodes away mostly the ability to live a decent life for people that are middle income and below, because rich people have assets and other stuff that can retain value much more easily. As you said, Stelio, the stock market usually responds to inflation, at least after an initial shock, by maintaining value, because many companies do have assets backing them, so they have book value, right? So when a company has buildings, etc., it's that has also to reflect the actual
Absolutely.
the actual real prices. But poor people or people middle lower income don't have such assets, right? And then you have a huge social blowback. Anyhow, took more than I wanted. So let's go back. Stelio, did you have anything else to say before we go through the charts?
No, we went through everything. I mean, the only thing I didn't talk about was the ECB, which was yesterday, and I wasn't on the webinar. But Draghi again, so one of the same, and dovish, and I just don't see how these people are going to contain this problem. It's we're supposed to be having a recovering economy for the past 8 years or 9 years, and they're having to go back to accommodation and zero rates or negative rates. It's scary.
Yeah, it is. And as we said, there are going to be repercussions for that. Nothing is free.
Yeah.
Anyhow,
Okay.
back to the charts. Obviously, Euro had a magnificent day yesterday, but as I was also writing in the chat room, my favorite here was the USD Swiss, especially if you remember, I covered specifically the USD Swiss yesterday on this webinar, saying that it's very well positioned because we had this beautiful pennant here, ascending wedge. You can call it whatever you want. In essence, it was a continuation formation, as you see. Very nice RSI divergence as well. As you know, always the target in such a case is a full retracement, which we did get. 98.50 was my target, and we're exactly there. Now, do I think that's it? No, I don't. I don't. I think that we might have some kind of a short-term reaction, and Blake mentioned it as well. Undoubtedly, I mean, sell the dollar rally. Now, there is one last line of defense that the dollar bulls are still holding, barely holding once again, which is this ascending channel. I'm showing it to you on the 4-hour chart. Yesterday, we also saw the equivalent channel on the daily chart. So we're still barely holding this ascending channel. So it is literally the last line of defense, technical defense, I mean, for the DXY. Do I believe that we're going to hold again and rebound from here and go to new highs? No, I don't. I believe that, we might even break down today. Even if we don't, best case scenario, best worst, depends on, how you're positioned. We're going to do something like that. But I strongly believe that, the current conditions favor selling dollar rallies. As Blake mentioned, there are a lot of people that are going to try to fade, these moves, and they might succeed in making some pips to the upside. They might actually succeed. Am I looking to do that? Absolutely not. I'm not looking to do that. I'm looking to do the exact opposite. Now, even having a look at commodity currencies, the Aussie has broken above this channel. That didn't happen yesterday, but it produced continuation due to that. So it has already done a move here as well. Of course, it needs to do more for me to be convinced that, it's the beginning of something, but definitely we're off the lows. Same deal here with the Kiwi. Kiwi once again found support roughly at 65 cents, rebounding higher. The pound, let's have a look at it. Here it is on the 4-hour chart, and then I'm going to show the dailies as well. The pound, after posting a fresh new low, which usually is very tricky when that happens, quite a nice rebound from there. I'm closely monitoring. I wrote it yesterday on the chat room as well. This 127.60 area of resistance. I think that if we break above it, there's going to be more upside coming for the pound. And keep in mind, a lot of those pairs are actually very close to key levels that once they start taking them out, we're going to see big squeeze coming through, right? So we're not far away from that. Actually, the dollar is, as I speak, the dollar has been strengthening. But as I said before, I do believe that any dollar strength within the next couple of days, I mean, within this week, is probably a good opportunity to sell the dollar than anything else. Now, having to do with commodity currencies, obviously, two of the strongest moves that we've seen is the USD CAD and the USD NOK. The USD CAD got rejected from this 134.40 resistance area. I would have actually sold it if what was holding me off, as I said, days ago in this webinar, is the fact that we had this false break lower from this inner channel. And although I pinpointed this area as resistance, the fact that we had a false break lower was really constraining me from taking a short position, because sometimes, very often, when you see a false break, usually you see a big move to the opposite direction. What I did short yesterday, though, in the chat room was USD NOK. I can show it to you on the 4-hour chart and explain exactly why I did it, because at some point we had USD NOK moving lower yesterday. We were in this candle, and at some point the dollar started strengthening, and when we actually retraced back to 8.705, we had retraced quite a lot from the lows that we had at that point. So I decided, I had no position, but I liked that wedge very much. I knew that we had the Norges Bank coming, and the Norges Bank has really showed their intention, at least not to be dovish, during the past couple of meetings. So I thought, this is a good opportunity. I sold half a position there, and I actually found out how well it worked when I woke up in the morning, because, as Blake said, the vast majority of the moves took place during the Asian session. Now we're trying to stall here at the 61.8, but the technical damage has already done on the daily chart, and you can see here why. Don't forget, I've been mentioning the importance of this ascending channel for quite some time now, and we have now breached through it, and we actually tested earlier today the 200 daily moving average. I think that if we break below that as well, then the next stop is at 840. 840, quite a significant area of support. It was this multi-year corrective moves resistance. It might act as support, but I think that 840 is easily doable. Now, if we get to 840, I'm going to be more than happy to take profits there, and we see what happens from there. But I do think that USD NOK, after yesterday's move, at quite an interesting point. I think we're actually breaking down, and there's more downside to this. Now, I'm not gonna speak a lot about gold, because there's nothing more to say than, first of all, we've shown it multiple times. Second of all, Blake covered it. We had this ascending wedge, which actually broke to the upside, which makes it, even a more formidable, bullish break. We almost made it to the first target I was looking for if we broke higher, which was the 161.8% extension of this corrective move lower, as you see at 1396. Now, the question is, where are some bigger targets we should be looking for? I think, we should go back to the chart and look for them, but I think like 1425 is probably the next area to be looking for gold to hit. And as long as we remain above this like 1350, 1360 area, I would not try to fade gold. I mean, I'll put it as simple as that. Okay. Now, having to do with silver, silver is also recovering from this descending wedge. But why would I want to be involved with silver since gold is still overperforming? I mean, we've seen that gold has been overperforming for a period of time now, and until I see something different, my weapon of choice remains gold. For those that are monitoring the webinar, you know that I already own part of my portfolio is physical gold. Same applies to Stelios. So, I have a position in gold. And, if I see any decent pullback, I am also going to, buy gold in the market as well for a trade. Now, having to do with the rest of the metals, palladium breaching through that resistance, I told you since yesterday, I mean, it looks quite bullish. There's no question about it. Copper also recovering, currently testing resistance. So, keep a close attention to that, because don't forget that copper responds pretty much, on expectations about growth as well. So, it's not going to move based only on what the dollar is doing. And one more thing, if you remember, we were talking about crude yesterday. I told you that, this might be a triangle, but, my exact words were that it's very, very hard pinpointing the nature of a corrective move. So, I wouldn't be surprised if we actually broke higher. So we have broken higher following, dollar's weakness. But I'm still viewing this move mostly as corrective. I do think that crude should be sold on any given, reversal. So, for example, I would be keeping my eyes on this 57, 50, 58 dollar area. If I see this area being tested and getting rejected, of course, it depends on the structure of the recovery until that point. I will most likely be selling crude, once again. We know that this was not a triangle anymore, by the way. That's a given, but we don't yet know the nature of this move. Okay, so, we have to remain a little bit patient. I'm not looking to be buying dips in crude though. Okay, I'm looking to be doing that for gold, but not for crude. For the same reason, more or less, that I mentioned about copper. Okay, crude response is very sensitive to growth expectations. Don't fool yourselves. The Fed is not about to cut rates and go into monetary policy lunacy because they believe they have a strong economy and they just want stronger inflation. They're doing it because they're very much afraid that the economy is slipping into a recession. Okay, so that should tell you a lot. S&P all-time high, yeah, no surprise there. Kostas mentioned it a few days ago, and I told him, he said, 2960 by the end of the week. I told him, yeah, sure, why not? And why not higher? Even 3,150 wouldn't surprise me. But I have to mention something. I've shown it multiple times in the past. I do pay very close attention, and I respect very, very much this Andrews pitchfork that I've had on my charts for years. Every time we retest the outside trend lines of this pitchfork, we fail, and we fail, spectacularly. So once we get back on this trend line, because this is the 100% trend line of the pitchfork, and that one, the outer ones are the 200%. Usually those are not on a chart by default. I've just put them. That shows that the market is very, very frothy, and usually that's when you see big reversals. You can see it here, you can see it there. If we zoom back, you can see it there. Every time we usually approach the 100% line, we get rejected. we've made it a couple of times to the 200% one. One of them was this mania phase that we had at the end of, at the beginning of 2018, at the end of 2017, and then almost repeated 1 year later. Okay, so I do believe that at some point, now the market is very happy about, central banks stepping in, pedal to the metal once again. But I do believe that this part is going to be over at some point. Now, would I be betting against it, just randomly? No, absolutely not. Okay, I wait to see for some kind of a signal. At some point, the market is going to stop ignoring what it has been ignoring for, such a long period of time. And when that happens, there's going to be a lot of downside. Until that happens, you need to keep respecting the trend. If you remember, I shorted the S&P a few days ago. I actually made the pattern play as well. That worked out quite beautifully. And I'm not looking to be short again. Not imminently at least. So I do think that indices are in buy the dip mode. If you remember, I've had a constructive view for the past several weeks, both for the S&P. This was clearly a corrective move lower, and the DAX, which is indicative. Okay, as you see, the DAX has been breaking above this channel as well. I see more upside coming. I mean, as simple as that. From a technical perspective, there is no reason to be trying to fade these moves as we speak. Same thing with the FTSE. You can see it here, clearly a corrective move, a pennant here. We're breaking higher. You can see upside targets. I mean, it's as simple as that. All of them, the European and the US, at least look quite constructive, and it is what it is. Now, I had a question about the Bund, and yes, we should definitely have a look at both the treasuries and the Bund today. And yeah, unsurprisingly, the Bund is just pushing new highs day in, day out. The next big area of resistance I'm looking for is this multi-year corrective moves 161.8% extension, which comes at 176. There is no reason to try to fade this move. I mean, the Bunds are at all-time highs for a very good reason. And, it is what it is. And here is the treasuries as well. Treasuries pushing the ascending channel once again, traded earlier even higher above this previous high that we had in September 2017. And if you have a look at the yields, which we also had a look at them a few days ago, yields below these lows as well, and currently almost at the 2% marker. Okay, do I think we're going lower? Yeah, sure. Why not? I mean, yeah, at some point we're going to see some kind of a rebound. Nothing moves in a straight line. There's no question about it. But I think you should be very careful trying to fade these moves because they have a good reason for happening at the moment. This consolidation here was textbook as well. We had marked it on the chart. Back then we marked, a few days ago that, there should be more downside, and we got that. Now, would I be selling down here? Absolutely not, because I have no risk reward that makes any sense. But as I said, that doesn't mean you should be trying to fade them. Okay, not unless we see some kind of a, big technical signal and perhaps some, short-term fundamental reasons to expect for a recovery. What do you think about EG? Actually, thank you for reminding me. By EG, our friend here means the euro pound. I actually added to my euro pound position yesterday. I was already in the money, and I was looking for a move below 88.80 to add. So I did add. It has rebounded since. It's much better if we go to a 4-hour chart and have a look at it. So here it is. Here is the euro pound. Rebounding from here, but I did that yesterday because we broke below this channel. I don't want to really see euro pound above like 89.50. As long as it's below it, I think it can continue lower. Okay, for at least one more leg lower. So that's what I'm looking for. I have a short position. My first entry was at 89.30. My second entry was at 88.80. So I'm roughly at the money as we speak. So I want to see what's going to happen from here. I'm going to know soon if I'm right or wrong on this one. But, I'm risking very little. I mean, my stop loss is very, very tight. So, no big deal. I mean, if it works, that's going to be beautiful. I mean, it's an amazing risk-reward ratio. If it doesn't, fine. I mean, I'm not going to regret giving it a shot because from a technical perspective, it made all the sense in the world. Okay. And if we covered this. Forex Gal says QE4 forever. Yeah, looks like it. It's not going to be forever. At some point, this whole concept is going to collapse and they're going to have to do something different. But yeah, if it was up to them, that's how it would be. My pleasure, Joanne. Coach, are you with us? Dale? Want to see
Yes, Steve, I just had it on mute. Yes, I'm with you.
any chance we have? He isn't here with us. Okay.
Not yet.
I wouldn't have a problem starting with Mark earlier because I would like to discuss with him and comment a little bit on what he thinks about monetary policy now, because we can start, with, discussing yesterday's developments before we go, into whatever he has in mind of discussing. I know that he's definitely going to spend some time talking cryptos. I'm not on board with that, but
well, feel free, Steve, to ask him whatever you want. You could. I welcome you to co-anchor this interview with me.
Mark is always a very nice.
But he's aware of it. I've emailed him. I've tweeted him, so he'll be here.
No, I have no doubt. Oh, he is here actually.
Oh, I just.
Don't worry, I'm promoting him right now.
He's here.
I'm promoting him right now.
Okay. Well, Mark. Yeah. Oh, you already made him a presenter?
Yeah, panelist. Yeah.
Panelist. Okay.
And I'm unmuting him.
Okay. Welcome back, Mark.
Good morning, guys. How you doing?
Good.
Good
Great to have you back, Mark. This is your kind of board. Are you going to be screen sharing at all?
I certainly can if you tell me how to do that.
Okay.
In the panel that you see when you mouse over, I think it should be at the bottom of your screen at the moment. The screen you see, the Zoom screen. There is. Yeah, exactly. It's going to ask you if you want to take, the share screen from me. You click yes, and then you will get a page asking you to choose which screen you want to share.
Okay.
There you go. Perfect.
All right.
Oh, look at that.
Yeah, nice forest.
There's Mark hiking out there in the middle of nowhere with his wallet filled with Bitcoins. Okay, so Mark, what a great time. Timing's everything to have you here with what the Fed did, everything. I mean, this is your kind of board. Perhaps the resumption of a bull market in Bitcoin, dollar beginning to break down. I know that's been a theme of yours for a long time. The only missing element so far would be lower stock prices, as the hopium is generating another charge. Looks like new all-time highs in S&Ps are a layup. So why don't we start there? What do you think of what happened yesterday with what Powell did and his statement of I believe it's a law that I intend on finishing my term, not demoted to corporal from Fed chairman. So why don't we start there with your view on Fed policy and what's going on here? Because isn't it, I know the number was terrible today, but Peter Boockvar says the Fed is S&P sensitive. No reason for them to be S&P sensitive. So something else going on.
Yeah, look, I think there's so many things going on. You bring up many of them in the sense that, the whole idea of Fed independence has been called into question. Now, there are some that would say, the Fed's never been independent. They just seemed more independent because there was more opacity as opposed to transparency. I don't know about that. I feel like the Fed clearly in the last few years has become much more sensitive to overall markets as opposed to just focusing on their two primary mandates, inflation and employment. I think they've always been somewhat cognizant of what was going on in the markets, but I really do believe that the race to the bottom, as I call it, is going on fast and furious, and it's this whole idea that everybody is cutting rates, everybody has low interest rates, therefore weak currencies, and that's the only way to win in a world of a shrinking pie is to devalue your currency and get a bigger piece.
Okay, so I want to start with I took over the screen here.
Yep.
Because I wanted to show you what's happening. I know what's happening in yields, and just today's action. When you look at the 10-year compared to, if you see the 30-year, the 10-year is weaker. Look at the bonds the 30-year hasn't given up hardly anything. It may have bottomed last night in Asia. I'm actually looking for at least a temporary correction, if not something major in the bond market. DSI 90, dollar breaking down. I don't think it's going to be positive for bonds. You have a view on the bond market that people, all the bears are piling into at these levels. Do you think it could be vulnerable with what's going on? People paying 133 and change for TLT.
Look, I have talked about this for a number of years that, we're in a lower for longer period, and we're in a QE forever kind of environment. And, what's interesting is we know the game plan. We know how this is going to play out, because all we have to do is go to Japan and look 11 years ago into what they did, and then fast forward, and Europe is 9 years behind Japan demographically. The US is 11. And so it's not surprising at all that European yields are falling towards and actually through zero. We now have over 11 trillion with a T dollars of negative yielding bonds, particularly over in Europe. And so the whole idea that the bond bull market is over, that the bond yields are going to rise, I think is just misguided. And demographics is destiny. Old people don't buy stocks, they buy bonds. And every day 10,000 people in the US and Europe turn 65. And so we're following this demographic path of Japan. And what's really interesting, if you go back to 2007, so just over 11 years ago.
Isn't there any difference, and I've heard this analog, between, Japan, we don't want to become Japan. We really aren't Japan. I mean, didn't Japan have a different fiscal and
at least they're funding the spending internally. That's
compared to the U.S. Aren't there some differences? I mean, the yen is not the reserve currency. Aren't there going to be any differences where if we go the way of Japan, that the outcome might be different than Japan?
There are subtle differences, but there are always differences, right? I mean, they don't have as open borders, although we're trying to close our borders. So they're more homogeneous as opposed to heterogeneous. But the bottom line is, at the end of the day, governments always overspend for millennia. That has occurred, and empires always fall. And so, Japan 11 years ago said, we're going to stop doing QE. We didn't invent QE. Been doing it in other places around the world for over a century. So Japan said, we're going to stop QE. They were at 26% of GDP in terms of the Bank of Japan owned 26% of GDP on their balance sheet. And they said, we're going to stop QE. Market rallied a little bit and then collapsed. And they started buying bonds. And today they're well over 100% of GDP. And debt is 220 something percent of GDP. And for years, everybody said Japan was going to fall off the face of the earth, and Japan was going to fail, and the yen was going to fail. And And it hasn't. Well, why hasn't it? It's because, people still believe that there's this safe haven, either in the yen or in government bonds. And it's because in a deflationary world, just getting your money back is a win, because you win because prices are falling. And so people say, oh, well, we're different than them. Well, are we? If you look around, the world, there's a deflationary trend. It's very strong. And people want to say that, oh, all this money printing leads to inflation. It actually doesn't. It leads to deflation. It leads to slowing economies. And now with the trade war rhetoric, that makes slowing even more likely. And so you look at inflation expectations, they've collapsed.
Good segue into the trade war. I want to get there, but one other question, since you talk about deflation, an asset class that we rarely talk about here because we're traders, it's FX, it's instruments, but you talk about demographics. How about the demographics that as yuppies get older, they buy bonds, but they also pass away, but their houses don't die? Do you think that real estate will be, I knew you'd like that, homes don't die, they're still there. Do you think that this deflationary trend is going to catch the U.S. housing market to some degree, maybe not to the same extent it did in 08, 09?
Oh, no, look, it's definitely gonna catch, because, millennials aren't going to buy the McMansions. Millennials are living in apartments, they're urbanizing, they have no interest in buying a 6,000 square foot house in the suburbs. And there's going to be massive deflation in real estate prices. You're absolutely right.
They keep talking about there's no supply, though, Mark. I mean, where's the supply going to come? That's all.
There's no supply. There's no supply of entry level homes. So look, I think there's going to be a bifurcation in the market. Sure.
Okay.
But the reality is that millennials really, they've been raised in a digital world, in a world where you don't have to own things, you can borrow things, Airbnb, Uber, and Lyft. Why own a car when you can spend less money borrowing someone else's car and getting a ride?
That's a good comment on millennials, but is there any way we could talk them into using their voices and having a conversation or meeting them instead of just them being a text message?
Yeah, well, that's another issue.
Come on, I mean, millennials. Do they ever call you up on the phone, or is everything a text?
Everything's a text. Look, I have two millennials. I have two millennial children.
Okay.
And I also have a little guy.
It's good to actually meet people and be with people.
Yeah, look, there's so many things. But one last point back to your thing on bonds. My friend Larry Tentarelli says something great. He says, nothing good happens below the 200-day moving average. And that is absolutely true. And the direction of the surprise always occurs in relation to where you are to the 200-day. So when prices are above the 200-day, all your surprises are positive. Look at Shopify yesterday or whatever.
Gold.
When you're below the 200-day, all the surprises can go in the direction of the trend, negative. Now, I can't debate that there's a very nice, I'm not enough of a technician to know, what do you call an inverse of a shooting star? But there's definitely, pardon?
Hammer. It's a hammer.
Yeah. So there's definitely a hammer there on your 30-year bond chart. And, could I see a little rally, a little rally in yields and a little sell-off in bonds? Sure. But look, if we keep escalating this Iran thing, the demand for safe haven assets is actually going to go up, not down. So, when we're calling each other liars over, a drone mishap, I feel like I'm watching a movie. I mean, I really feel like I'm watching a movie. And
I don't think Rod Serling could have written a script that we're living right now.
yeah, exactly. Good point. Twilight Zone.
Yeah. So, all right. So, you think there's a pretty good chance of some miscalculation, or maybe it's calculated. You've talked about this. Historians will back it up that when leaders are under pressure,
Yeah.
that war is something that unites people behind their leaders. Do you think we're going to have a war with Iran?
Look, I think it's really spooky. So 2.5 years ago, right before Trump took office, I was at a conference for one of our hedge funds, and they brought in this outside speaker who was the former assistant defense secretary. And long story short, he said that over the next 4 years, we would see not the conflicts that we're used to seeing in places like the Middle East and other hot spots around the world, but he said we would see problems with North Korea, the Chinese Straits, or China, South Sea.
China Sea, yeah.
South China Sea, thank you.
Mm-hmm.
And in Iran. And I'm going, what are you talking about? No, it's definitely going to be Saudi like it always is, or it's definitely going to be,
Israel.
Something different. And sure enough, we did this stupid, creation of a problem with North Korea to then try to solve it, which they didn't solve. And so now it's just gone away. No one talks about it, failed summit. Although my favorite part of that was when Trump got off the plane and the announcer, I can't remember if it was on Fox or somebody else, said, and the two dictators have gotten off the planes to meet. And they're like, whoa, I meant the president and the dictator.
Freudian.
Yeah, Freudian slip. So now here we are with Iran. And look, two things happen. When economies get weak, historically, surprisingly, or maybe not surprisingly, if you're believe in this theory, which is what do? You go to war, because war is really, really good for economic growth. You get to blow up a bunch of bombs and drop them in the desert, and then you get to build them back up, and it's great for defense companies and great for employment. And so, look, Russia did this a number of years ago. They were going into a wicked recession after 2014 oil price crash. And what they do? They started dropping bombs in the desert in Syria, and magically their economy recovered. So,
okay. All right. So
I don't know.
Yeah, we have to be alert to so many different pots bubbling on the stove right now. Steve, I know you had some questions you wanted to ask Mark vis-a-vis economic issues. You want to go and do that now?
By the way, just a short comment. I mean, what Mark mentioned about wars and how they boost reported growth, and I'm saying reported growth is it comes to the question, not to the question to what I want to say before I ask is obviously there's this bad misconception, which I know that Mark doesn't do that. That you get a hurricane, that's good for growth. Why? Because we get to fix again what was broken, right?
Yeah.
But that doesn't actually increase the productive resources of an economy. Actually, it expands, part of the resources to just come back to where you were. So the same is true for wars. So this is another trick to do boost indeed the GDP in the short term, but does it actually make life better for people? Does it actually, improve the average citizen's life? No, it doesn't. It does get reported as GDP growth, but it doesn't add value to an economy. What I wanted to ask is, what do you think the long-term repercussions? From what I understand, you don't think that inflation is going to be a long-term repercussion of this monetary policy. There we disagree, because I do believe that yes, demographics play a huge role, but I do see the Fed and the rest of the central banks being very arrogant, believing that just because of demographics, they can go to QE infinity and everything is going to be all right. But I do think that, it's not probably going to be that easy. But what do you think? I mean, what do you think the long-term repercussions are going to be with, following this kind of monetary policy and fiscal policy imprudence?
Yeah, look, I think that the challenge for all of us is trying to understand and make sense out of, the greatest monetary policy experiment in the history of mankind. And, it's hyperbolic, but it's true. If you think about every other experiment of this type in monetary largesse and profligacy, it ends in hyperinflation. And so that's what everybody's focused on. They're focused on, Weimar Germany or Zimbabwe or Venezuela. And I think what they miss with that is those were, weak countries, minority countries in terms of stature in the world. And, yes, when a government that's weak and doesn't have a lot of relationships, and when the top of that government, I call it the dictator playbook, where the dictator playbook is to gather all the assets to your friends and your cronies, and then to systematically destroy the currency so that you become very, very wealthy. That's the plan. And so, I don't think you've seen that in Japan. I don't think you've seen that in Europe. You might actually be seeing it in the US. I do worry a little bit that there's so many similarities to the dictator playbook going on in the administration today in terms of, passage of laws that favor a very small group of cronies, using executive privilege to do things that the Congress would say, no, that doesn't make sense. It's not for the greater good. So I do worry a little bit about that.
And having fewer friends, as you said before. Strong nations have relationships.
Yes.
And friends. And, we've talked about like the Plaza Accord. It took coordination of many central banks to do this. I don't think there's a will or even a way for central bank cooperation anymore. What do you think?
Yeah, but I agree with. Well, here's the thing.
Central bankers, maybe they're a club.
Yeah, central bankers, I think, actually do still collaborate, and I do still think. Look, I think Christine Lagarde runs the world, and nobody pays attention to it. But she's in charge. She tells which central banker who's going to hold the baton, meaning which one has to be in the penalty box of a strong currency. And then they pass the baton to someone else so they can have the strong currency and the other people can weaken their currency in this race to the bottom. So I don't worry so much about the central bankers. What I do worry about is this notion that inflation can happen quickly because there's all these reserves that have been created sitting on bank balance sheets, and somehow they're going to get into the marketplace. And the reality is they just haven't. And why haven't they? Well, it depends if what you believe about why those reserves were created in the first place. If you actually believe that the central banks are printing money for the express purpose of getting that money into the economy and boosting inflation and boosting economic growth, then yeah, you should be worried about inflation. But if you take the other side, which I do, which is the only reason those reserves were created was to bail out the insolvent banking system after the global financial crisis, then you have a different view. And what you've seen is, loans have not gone out as quickly as people would have anticipated. Monetary velocity has collapsed down to depression levels like the 1930s. And I think we're much closer to a 1930s-esque economic environment than we are to a 1970s-esque economic environment. And I think when you line up demographics, economic policy, last time we used QE was in the 1930s. We tried to get out of it in 1937. I can make a very strong argument that we're exactly in 1937.
Because the Fed was tightening then, right? Didn't they?
They tried. They tried.
All right.
And they failed, right? They tried to tighten 25 basis points. Think about that. They tried to tighten from 0 to 25 basis points. They triggered a 50% decline in the equity markets,
Right.
and they reversed, and they went back to 0.
I think the exact same thing would have happened if, in this occasion, when the Fed tried to hike rates, if it wasn't for expectations changing on the economy due to Trump being reelected and the fiscal stimulus that came with the taxes. I think that the Fed would be completely incapable of hiking even 1 or 2 times.
Look, I said, I think we are exactly in a 1937 to the early 40s kind of environment, which actually quite frightening.
Could it be both, Mark? That first
Quite
we experienced the 1930-esque type of environment, because people forget how long lag time is on Fed policy, and for the next several months, I don't know, maybe even a year, even if the Fed begins to cut in July, we're still into the effects of a few years of quantitative tightening, right? So,
absolutely, it's a really important point.
Okay, so if they reverse, it could take a couple years before that stimulus plays through the system and starts to have impact.
Well, think about it, right? People are reacting to the announcement that maybe in 2020 the Fed will cut, and somehow that's good for equity prices. But what they're ignoring is the fact that, David Rosenberg has a great quote that, all cycles die. You know how they die. The Fed puts a bullet in their forehead. The Fed put the bullet in the forehead of this economic cycle 18 months ago. And there's a 36-month lag, to exactly your point, Dale. There's a 36-month lag between fiscal tightening, monetary tightening and economic decline. And every single economic indicator, every single one, is rolling over hard and is going to slip into contraction here. And so what people are ignoring is the reason the Fed is going to have to lower rates at some point is because we're going to be in a recession. And recessions are bad for stock prices. They're bad for growth. They're bad for employment. They're bad for all these things. And it's amazing to me the just ridiculousness of saying, oh, but confidence is high. Well, of course confidence is high. Confidence is always high at the top. Or unemployment is low, or unemployment is low. Well, of course it is. It's always low at the top. And it's not different this time. And we're not in a new paradigm. And all this talk about, oh, well, they're going to be different because we have all these policy tools. We've always had these policy tools, and now we've abused the policy tools. But the bottom line is we restricted credit and monetary growth. So monetary growth slipped to sub 5% for the first time in decades. And Raoul Paul has this great chart, and he's tweeted out a number of times. And it basically shows a near perfect 36-month lag between LIBOR and economic conditions and GDP growth. And LIBOR spiked 300% 18 months ago. And we're 18 months away from a trough in a recession that's going to be a doozy. So. Okay.
All right. So Steve, you have your answers for Mark?
No, because we shifted the topic. Nothing is free, Mark. So what do you think are going to be the long-term repercussions of such an imprudent, monetary policy?
Look,
I don't think it's going to be inflation. Okay.
I don't see inflation because I don't see the velocity of money rising, and I don't see demand for credit rising because an aging population doesn't start new businesses. They don't invest, they don't buy. People who are 65 to 85 save. And, occasionally they travel and stuff, and that's great. But the average 65 to 85-year-old is not very productive, the way we define productivity. 45 to 65-year-olds are very productive. 25 to 45-year-olds are not productive either. So we've got this terrible demographic situation. So we're not going to get the multiplier effect of normal economic growth because of demographic support. Then we've got the negative multiplier effect of, we haven't even talked about the deficit, right? The dumbest thing you could possibly do as an economist or a policy person is to expand the deficit at the end of an economic cycle. Absolute
vis-a-vis
suicide.
tax cut.
Which is exactly what we've been doing. I mean, the US is running a record deficits, theoretically speaking, at the end of an expansion. I mean, this is amazing.
No, it's suicide. It's that just shows a couple of things.
Classic.
One, the economic ignorance of the people in power.
Arrogant.
But two, it's the fact that I always say there are no parties anymore. There's just in power and out of power. And when you're out of power, you do or say whatever it takes to get in. And when you're in, you do or say whatever it takes to stay in. And so, this guy likes power and he wants to stay in power. So he's going to do whatever it takes. And if that means, cutting a deal with corporations to, I call it stealth QE, right? The Fed's not allowed to buy stocks. So what do? You go to a bunch of companies and you say, look, I'll cut your tax rate, but here's the deal. You have to buy back your stock to pump up the stock market. So I look like a hero. And that's QE. Any way you slice it, that is the same as the Fed buying stocks or the Bank of Japan buying stocks or the Swiss National Bank buying stocks. And if you look at, what was supposed to happen with tax cuts, we were supposed to have an increase in revenue, the old Laffer curve, which Trump's giving him the economic medal of freedom. What a joke that is. Revenues are down year over year, 26%, an absolute collapse. Deficits are up. And we're supposed to also have a boom in CapEx, which we haven't had, because all the companies are doing is buying back their stock, which is what they were forced to do in order to get the tax cuts. So the only people that benefited were the rich guys at the top of the organizations that issue themselves stock options at cheap prices.
That's
and
right.
then buy the
It's
stock
all
back
used
from
for
themselves.
financial engineering.
Yeah. So
Yeah.
I'm pretty cynical.
Speaking
I'm pretty
of
cynical on the whole thing. So to answer your question, what are the repercussions? I think the repercussions are slower economic growth, more income inequality, more bankruptcies, more negative growth in the economy over the next couple of years, and a really long, drawn-out period. I hope it's not as bad as the late 30s and into the 40s, which we all know was the Great Depression. Forget recession. But look, we're making all the same
great
mistakes
about
that we
either
did
of
in the
those.
30s.
Well, the Great Recession wasn't great for me. Mark, I think people are going to think, well, you know what, Dale's gone, he's gone off the reservation with a question like this. But I just get the feeling, the way you talk about dictators' playbook, etc., it's something that's been in my head. And people have talked about this way before Trump and going all the way back to the Patriot Act. The president has a lot of power, so he loves power. Will he leave if he loses the election, or will he use the powers to call off, suspend the election, maybe martial law? Is he going to leave if he loses?
It's a great question to ponder, and I think it's actually pretty reasonably likely that he is going to lose the election. There are a number of credible candidates that I think could poll much better than him. Pete Buttigieg to me is my favorite. And some people think he's too young, but I think he's absolutely brilliant and a great choice, great leader. So I do think there's a chance, a reasonably likely chance that Trump loses. But to your point, could he just say, hey, you know what? I'm not, could he pull a Maduro? I think it's absolutely possible. And look, the world has gotten stranger and stranger. Look what's happening in China. China, Xi is supposed to, be done after this term, but he appointed 6 people to the Politburo that are all next party Congress will all be above 65. The only person below 65 will be him. So technically, the president has to come from that 7-person group. And so he's set it up so that he has to be president, even though he's not supposed to. Now, China's a little bit different. It's not quite the same, but are people all around the world doing things that defy logic? Yeah, we're seeing lots of it all around the world. So I wouldn't be surprised at all to see that type of environment. I do think we have a few more checks and balances here, I hope. But that wouldn't surprise me in the least. I mean, look, it's like look at this Jerome Powell thing. Okay, it's very clear what the law is.
Right.
The president has no power to demote, the person that he appointed, by the way, from Fed chair to a governor. No, there's no precedent, no way legally to. But even though that's come out as, okay, everybody's checked and that's he still claims, right? I can do whatever I want. I can do it. Like, well, but you can't. And so we are in a surreal world, surreality. I've been calling it the new abnormal, but I think it's actually gone from the new abnormal to this surreality. It's like, it literally is like watching, reality TV or surreality TV.
Okay. So you're going to stay in the country and ride this out?
That's a great question. So one of my friends has relocated to PR, which is still the U.S. technically, right. I guess, but
with tax advantages too.
Yeah, huge tax advantages.
Who's that? Harry Dent?
Actually, Harry has done the same, and John Malton's done the same. But they're just a close friend. But a number of people have done it, and that's not far enough. You got other people.
There's too many people on that island to call that a haven, as far as
I know.
Anyway.
My mentor years ago set up shop. Julian Robertson set up shop in New Zealand. That's pretty far away. And that has the other benefit that no one talks about, that it's the only place.
You're gonna ride it out in North Carolina. I know you.
Yeah, well, look, I like the idea of New Zealand because it's the only place on the planet where nuclear fallout wouldn't hit, which I think is kind of interesting.
Well, do you know who Martin Armstrong is?
I know that name for some reason.
He's called, one of the greatest forecasters, and he went to prison because they said the CIA wanted his numbers. Anyway, he talks about New Zealand, Scotland, and I forgot the other country, but Scotland's one of them. So why don't we wrap it with something so close to your heart that I think you have a B written on your heart. I know that there was definitely a sigh of relief for you and some validation that I think I tweeted you and I said I did my first crypto trade. I bought GBTC at $4 and
love it.
Got out of it too early at 7 because I don't know how to hold anything. But to me, this looks like it could be the resumption of a bull market and we'll take out that 18,000, or I would love one more break. But you see the chart I have up there? I'm showing. Someone I interviewed talked about a ghost month in August, and the Asians are real big in it, where they don't trade as much, and maybe if things are under pressure into the fall, there's one more pullback in Bitcoin. But I'm assuming you're looking for the high at the end of 2017 to be taken out.
I mean, I believe that we're in a long-term bull market in this asset. And the reason is because we're in a race to the bottom in all the other global currencies. And what people forget is, if we put up a chart of Bitcoin, just Bitcoin, right?
Yeah.
Weekly? No. Your chart's fine. But if you just put up a chart of Bitcoin, which doesn't exist, right? One Bitcoin equals one Bitcoin. So it would just be a flat line at 1.
Oh, okay.
Every time we put up a chart, it's relative to something else. And so if the chart that you show right there, the ascending line, right, is Bitcoin relative to the dollar. And what that's showing us is not necessarily Bitcoin getting stronger. It could be that the dollar is getting weaker or the dollar is getting less valuable.
Less confidence in it to hold.
Yeah, I mean, so there's all kinds of nuance anytime we talk about, because if you look at the price of Bitcoin in Venezuela or in Zimbabwe or in Argentina, okay, it never even had a bear market. You go all over Latin America. Bitcoin prices never had the bear market that we all experienced relative to the dollar last year in 2018. So it all depends on kind of where you are and what you're crossing it against. And so what I find, I tweeted this out the other day, is if you take the long-term gold chart, like the super long term, 140-year gold chart, it looks spooky, just like the Bitcoin chart. I mean, from the 70 and 80% declines, from 1980 to 2000, gold fell 70% and was down for 20 years before it resumed its increase. And there's all these gold bugs out there saying, oh, well, Bitcoin doesn't work because it's got such volatility. I'm like, really? You mean different than gold's volatility back in the 30s or back in the 1860s? Or, I mean, stores of value are measured in centuries and millennia, not in months and weeks. And so as we think about this as digital gold, and we move from an analog world to a digital world, the demand and the use for this asset, I think, is just going to rise. And so to me, I always say price is a liar, right? Price is the indication of what two people will exchange some unit of value or some number of units of value. So the price of Amazon at $1,900, that's not the value of Amazon. That's the price that two people will trade 100 shares. So 93.04 is just the price at which someone will trade a Bitcoin from one person to another. But that's not the value. The value of a network or a system follows Metcalfe's law. And Metcalfe's law says that as we increase the number of users of a network, the value of that network rises. And so you think about Apple wasn't very valuable. When there was 10 iPhones, still not very valuable. 1 million iPhones, more valuable. 10 billion iPhones, really, really freaking valuable. And the same thing is true here. Every time new people start to use Bitcoin as a store of value and ultimately as a medium of exchange, the value of that network increases. So, back in 2017, when the price hit 20,000, the value, the underlying value based on the users and all that was far below. So the price was a liar. The price was overvalued. And so we were going to have a bear market. Now, bear markets usually go through fair value and they go below. So we think it got far below fair value. And, in our fund, we have a venture capital fund that can buy a little bit in direct crypto as a network. And so we started buying in April because we thought, at $3,000-4,000, this the price again was a liar and the value was significantly higher. Today at 9,300, I still think that I think we're still below fair value. We're closer to fair value. I think fair value is somewhere in the low double digits, $11,000-12,000.
Okay.
But it's increasing rapidly because if you look at the fundamentals of Bitcoin, they're all improving. Number of wallets just hit an all-time high. Number of users, all-time high. Size of block, all-time high. Number of transactions, all-time high. All the fundamentals, the things that you would judge any network, like the number of phones, attached to a network or the number of minutes people use on their phones.
So this is a mass adoption cycle that we're entering here.
Exactly. And we're at the knee of the S curve, right? And so we're going from, the early adopters to the, early majority. And we've got, 75, 80% of the S curve to go. And, the long term, look, I've never seen an opportunity so clearly where the asymmetry was so perfect, right? The upside relative to the downside was so great. And people always go, oh, but it could go to zero. No. If this was going to go to zero, right? If this was going to die, it would have died somewhere between 0.003 cents and $10. That was the miracle. The miracle was not $10 to $100 or $100 to 1,000 or 1,000 to 10,000. The miracle was, 0.003 cents in 2009 to $10.
Yeah, getting off the launch pad. Once it got in through the atmosphere, different story. Okay.
Yeah, and now we have the Lindy effect, right? Which is the longer something exists, the more likely it is to grow. And it's like infant mortality. Infant mortality, if you survive birth, right, you have a high likelihood of reaching a certain age. And if you hit 65, you have a really high likelihood of making it to 80. And if you hit 80, you have a really high chance of making it to X. And so the Lindy effect is in full force here. And we've gone from a science experiment to a novelty to, a real asset that people view as a alternative to gold to, oh, wait, this could be a base layer of Internet 3.0. And as I say, this is just technology, and it follows the technology cycle. 54 was the mainframe, 68 was the microchip, 82 was personal computer, 96 was the internet, 2010 was the mobile net, and 2024, still, 4.5 years away, is the trust net, or the Internet of Value, or the Internet of Things, whatever you want to call it. But that's going to be when every major company in the world will run on a blockchain, and the first trillionaire will be created from the wealth created from this, the same way that the first multi-billionaires were created with the wealth created out of the internet and the mobile net. And it's an exciting time to be involved. And I feel badly for the people that focus solely just on price day to day and get all nervous when it has volatility. We love volatility. Volatility is how you make long-term gains. We want volatility in an asset.
You're one of the most effective ambassador spokesperson for the cryptocurrency world, Mark. And I've really enjoyed.
I appreciate that.
I've really enjoyed seeing your appearances on CNBC, and always eye-opening for me to talk to you for 30, 40 minutes. And I want to thank you from myself, Steve, and the community for edifying us once again and bringing us up to date. You really are a voice of reason in, as you say, a surreal world, Mark. So thank you for what you do and all the insights and straight talk you give in a mashugana crazy business, Mark.
Well, I appreciate the kind words. I really enjoy our conversations. I love Steve's questions and holding my hand to the fire when I don't actually give him an answer.
Yeah. You are. I've interviewed many crypto people, and you build the case to where after I hear you talk, I have to trade in my leather wallet for a metal one.
Love it. Well, we'll do it together, and we'll be able to enjoy our golden years with our Bitcoin hoard. So
okay, and let me know where you go offshore, okay, buddy?
I will. I'll save you a spot.
All right, and everyone, that's Mark Yusko, and you could follow Mark at Mark Yusko on Twitter. And the name of your company again, Mark, for people to go to your website and check it out.
Yep. So it's Morgan Creek Capital, Morgan Creek Capital Management. We also have a subsidiary, Morgan Creek Digital, but you can find us at morgancreekfunds.com or morgancreekcap.com. And at the morgancreekfunds.com, there's direct links to what we do on the digital side as well.
Okay, I wanted to ask you, do you guys have any projects that you have going on? I'm bringing up your website now, Mark, that retail investors could get involved in as far as, I know you handle managed money. Is there anything a guy with, say, 25, 50 grand could do with you guys?
Yeah, the only challenge for us is, because we deal in quote unquote alternative investments.
They have to be accredited investors.
Yeah, we're still subject to the accredited investor standard. I did, Jay from the SEC did say yesterday he is open to the idea of changing that. So let's all work on lobbying to get him to do that.
So for people to get into this digital asset index fund, they have to be accredited investor.
You have to be accredited investor, and we're working on that, trying to find ways to. We do have one. Well, actually, everything we do is either accredited or qualified, but we try to get as much available for accredited investors as we can.
Yeah, it'd be nice to make it available for regular people that don't have 5,000K.
I'm working on it.
Outside of their home, I believe that's.
I know. We're working on it. We're lobbying hard, and I've always said that the accredited investor standard was not created to protect the less wealthy. It was to protect the more wealthy and keep them having all the good ideas. So,
well, good luck on leveling the playing field. That would be a paradigm shift in investments too. So, again, Mark, thanks for your time today, my trading warrior brother, and appreciate all the views and insights you shared with us today.
No, thanks again. I always enjoy it, and we'll see you again soon.
Okay. Thank you, Mark.
Take care, guys.
All right, so
Thanks.
that's it. Remember, everyone, don't just count your Bitcoins or pips, count your blessings, and we'll see everyone to wrap up the week. Adios.